Good afternoon, everybody. Yes, I am smiling. I got to go to Lake Tahoe this weekend, and there's one question people must ask themselves every time they go to Lake Tahoe is, why don't I live here? It was just absolutely incredible. Of course, I jumped in Lake Tahoe, sub 50 water, had to be closer to 40, but that was a lot of fun, woke me up, and really excited to be back here live with you. We've had some amazing guests over the last 2 years, really, and it just keeps getting better with today's guest. And we've been featuring veterans throughout the summer. We have Veterans Day coming up, a lot going on there as well. But enough about me, enough about the House of Bricks community. Looking forward to inviting actually one of the advisors for the House of Bricks onto the show today. So Jeremy Segal is Executive Vice President of Corporate Development at Progress, where he leads sourcing, executing, and integrating M&A deals. Over his 25-year career, he's driven more than 35 acquisitions and joint ventures worth in excess of $10 billion. He holds an MBA from Cornell University and is also, and I agree with this, some people put stuff in their bio that they're stretching, but Jeremy is a very strategic thinker. He actually led the acquisition of my company, Velocitude. So Jeremy and we go all the way back to 2010 and stayed connected. And I talked about this at the conference this weekend, the importance of relationship capital. So having a peer or a mentor mentoring you, peers you're climbing the mountain with, and then also people that you're mentoring. And then at the center of that flywheel is that self-leadership that we talk about. So Jeremy, I'd like to welcome you to the House of Bricks Live.
Thank you so much, Adam. It's great to be on the House of Bricks show here today, and great to be working with you again. It's amazing, 15 years that we've known each other. It's been a great run.
Yeah, and I wouldn't say we were really working the deal together, right, to get the Akamai Velocitude done deal, but we were kind of on other sides of the table, bearing that fine line of, hey, I'm your friend, but I also want to get the best deal possible for my company. It seemed like you were able to balance that pretty well. Like, is that a skill set you've developed over time? Kind of, because I was excited for the outcome.
Yeah, it's a great question or a great point, and I think it's super important, and something I learned early on in my corp dev career is the importance of finding some level of balance, so that the seller doesn't feel like they're losing every single deal term and just getting gouged, but really trying to understand what's important to the seller, knowing obviously what's important to me as the buyer, and making sure I can find an appropriate level of balance so that the seller feels good about the transaction ultimately, because at the end of the day, you're going to be part of our company. And so we want to make sure you come in with positivity and feeling good about the company that just acquired you, not feeling like you just got killed on every single deal term.
Yeah, no, that's a great point. And like I said, now we can be honest, right? Martin, my CTO, and we were definitely intimidated going into, and you knew it, who was this 29, 30-year-old kid walking into a multi-billion-dollar public company with a mobile web technology. What do you think is the most important thing for a founder when they're thinking about exiting their company?
There are a bunch of things, and I think one of the things that stood out about you and Martin when we were having our initial dialogue with you guys was that level of transparency and honesty that you guys had about your business. I think building that level of trust and feeling good about who it is that you're interacting with is really, really key. And I think me, Robert Wood, who was my boss at the time, others within Akamai, really enjoyed the interaction, felt that we were getting answers to our questions in a straight up way. There wasn't a lot of, we need to get back to you in a couple of weeks, which sort of leaves you with a little bit of concern of why can't they answer that question? So, you guys were prepared, which I think is another piece that's important. But, as I laid out in that article that I wrote, I sort of look at sort of 7 big drivers that, I think as you're a CEO thinking about potentially selling, your company, you should think about, and you should be prepared to talk to the acquirer about. And I'm happy to go through those one by one, but happy to follow your lead too.
Yeah, we'll definitely jump into those, and that's where I was heading next. But one thing I think is very important, and remember our audience, we have CEOs, early stage founders, venture capitalists, private equity, kind of across the gamut of people that are involved in transactions, raising capital and exiting businesses. Something that you just said, I think, is really important for both sides of the table to understand is no one has all the answers, whether you're the buyer or the seller. And I think a lot of founders, I know now, just having done this for 30 years, it's better to get the issues on the table early rather than let them come out, because all it takes is one unknown term in the deal to send everything. Now, wait a minute, if that's wrong, what else is wrong, right?
Yeah, and it goes to that point around trust. It goes to that point about being prepared. But it's a great point. I'd rather you say to me, "Hey, Jeremy, that's a great question. I'm not quite sure I know exactly how to respond to that. Let me go back and talk to my CFO, or let me go back and talk to my chief technology officer, so I can come back to you with a clear answer." And I think we respect that a lot. We don't expect you to have every single answer to every single question, which is part of the reason why also in the article I talked about, the importance of maybe not just being the only interface between the acquiring company and your team, but bringing in some of the subject matter experts so that my subject matter experts can get more conviction and get more confidence that, the technology that you have, the product set that you have, the go-to-market strategy that you've taken, they have a better understanding of all those things.
Yeah, and you're jumping into it, so let's just do it. I told you Jeremy was a strategic thinker. It's like, boom, I got these 7 things. We're gonna knock those out. So let's get right into it. What's the first thing that a founder should be thinking about when they're looking to exit their company?
Yeah, the first thing that I talked about was knowing the why, like really sort of taking a step back and reflecting. Are you at that inflection point where you're trying to figure out, do I go and raise more money and try to execute on my own? Do I need a bigger platform and it's just going to be too difficult for me to do this on my own? Am I losing deals because I'm just a small player, but I have really good technology? And if I had a bigger company that I was part of, I could do a lot more with this technology, with this asset. And so, there are all those kinds of questions that I think are important for the CEO to think about and really sort of get committed. Do you really want to sell, or are you just sort of exploring this? And it's one option, and you might raise money as well. Really, just trying to have as good a handle on why it is that you're looking to explore potentially selling the business to a bigger platform.
Well, I can't wait to get to this question, which is, how many investor presentations have you seen with a hockey stick chart? Every one of them, right?
I think it would be a much easier question if you asked me how many didn't, and then I'd be able to do it on a handful. Yes, it's fascinating to me. And in Progress, as a value buyer, we're not looking at companies that are growing 20, 25, 30+%. We're looking at companies that are growing anywhere from mid-single digits to mid-teens. But it's always interesting, particularly when a banker prepares that deck, how a company that, for 2-3 years has been growing like steadily, but then all of a sudden, hey, we've got 6 to 8 different levers that are going to just help us go in a rocket ship. And so the next 3 years, we're just going to double and triple the size. It's fascinating. I mean, we sort of disregard that almost entirely, and really focus on the historical side and what has the business done over the last 2 to 3 years, because we know that everything's glossied up for the go forward side of the business. And so really is trying to understand what have been the trends in the business, where have there been issues, where could Progress potentially run that business better, given the fact that we have a massive distribution vehicle, given the fact we have 200,000 customers, given the fact we're a global company, you name it.
Isn't it amazing how everything just works out in 2 years and they pull all 7 levers at once and magic happens, right? We're just going to 10x our growth. It's amazing.
So it sort of hits on the second point that I talk about, which was, do you hire a banker or not? And like, you guys didn't hire a banker, but you had also sold businesses before you sold Velocitude to us. So you had some experience. And in my view on this is, on the one hand, I don't love having a banker as the intermediary between me and the selling company, particularly if that banker doesn't necessarily have, isn't necessarily motivated to sell to me. But on the flip side, particularly if you're a newer CEO or you've never been through this process before, going back to the point about being prepared, that's where, the bankers can really help. They can give you a perspective on where your value should be, because a lot of CEOs, they're obviously going to think very fondly of their business and think they're worth lots and lots of money. And it's always helpful for a banker to say, hey, given the kind of trends that your company has seen or the size of your business and the profitability of your business, you really should be thinking of a value more in the X range. And I think sometimes that conversation can be hard for a CEO, but it's also sort of bringing a level of reality to the CEO, which I think helps. And I think that, and then, being able to have a more robust set of data for a buyer to be able to review, being able to prepare that more effectively and efficiently, and taking some of the pressure off of you as the CEO to have to pull all this stuff together, there's definite value there. And they can also help protect you with regards to certain deal terms if you don't understand a deal term. And so, my perspective on it is, more times than not, particularly in the deals I'm looking at, there is a banker on the other side. And, what I try to do is just try to figure out how best to establish a relationship with the CEO directly. So I'm not always having to go in between the banker, but I do think that the banker can add some real value to the CEO and their company.
Yeah, and I was also very fortunate, right, to have an advisory board at the time. I had Scott Barrett, who was CIO of Blockbuster and friends with Wayne Huizenga, and Craig Farley, who ran M&A for Wayne Huizenga. Anything in South Florida at that time was Wayne Huizenga. Someone either worked for him or, was partners with him or something. So, but it's something I talk about all the time, the importance of having advisors and coaches, because they can take the emotion out of the business. As a founder, you're wrapped up in it 24/7. You're giving your whole life to it. So having that sounding board, whether it's an advisor or banker, just to bring some logic. And I see this all the time. Even a founder I'm working with now, I tried to warn him, but a big company was coming in, looking at buying them. They throw some big numbers around, and he didn't really focus on the business. And I think that's a key factor of what a banker can do for you, or advisor, is you have to do, they're two separate things, trying to sell your company and trying to run your company. And it can really rock the apple cart.
Absolutely. And I've been on that side too, Adam, because when I was at LogMeIn, we sold the business to Francisco Partners in a leveraged buyout. And it was incredibly time consuming. It was, and we had a banker too. So, without that banker, just think about how much more stress on you it's going to put on, and what that potentially means to the business.
Right. Well, let's jump into your next point here. And we've talked about some of these, but let's drill down on this one.
Yeah. See, you actually touched on this one early, and you're putting issues on the table early. And, this is something that it's funny. I've worked for great CEOs throughout my entire career, and they've always reiterated the importance of this one. The last thing that we want to do is go through an entire process, and then at the end, find out something about the business that we should have really understood or known about at the very beginning. There's one deal that we worked on. It was a divestiture asset. And all along, we were very explicit. Is all the technology coming to progress? Is all the technology coming to progress? And then at the very, very end of the deal, they're like, well, we think we need to license back this and we need to license back that. And our preference would be for you to pay a royalty on this. And we're just like, maybe we could have figured this all out if you were transparent with us and told us about this in the beginning. If you're expecting a big customer churn, whatever the situation might be. If you're transparent, there are ways that buyers can figure out how to address that. But
Hmm.
if you're not transparent, there's a much greater likelihood that the buyer is just going to be like, well, now I don't trust you. And we've talked
Right.
about the importance of trust. And, if you're not telling me this, what else aren't you telling me? And where else are there challenges in the business that I'm going to learn about on the other side? And is it worth taking that risk at this point? So, I think it's just really important. I stress transparency all the time. My CEO, Yogesh Gupta, who's phenomenal, always stresses that when he's having early conversations with target companies as well. Hey, just if there are things that I should know about now, just tell me. Just tell me.
Right. Yeah. Just tell me.
Yeah.
Exactly.
So
Well, I was going to ask you too, and you mentioned that, and we were talking about it kind of early on. One of the biggest mistakes I see founders make is not making sure their numbers are right. Like Excel can be very dangerous. It just takes one formula. Or how often do you run into that? And any advice for founders out there? Is that something that causes concern when you guys find issues with the numbers?
It happens all the time, and that's why when you're reviewing the sim, you really need to review those footnotes at the bottom of the sim. Take for example, gross retention rates. You'll see this really great looking gross retention rate, and then there'll be a footnote at the bottom that says gross retention rate only includes X, but excludes Y. And then when you're like, all right, well, when you include both churn and downsell, how does your gross retention rate really look? And
don't ask me that. Don't ask that. It's going up.
So I think the key thing there is, again, you have to assume that the buyer is going to hire advisors as well who are smart, that the buyer is going to have a finance team that has done this time and time again and is going to be able to analyze that ARR waterfall and figure out what's really happening in the business. And so knowing that we're going to figure out what's really going on in the business, just be upfront. This is where our gross retention rates are. This is what our revenue recognition policy is, and just be clear about that. And this is how we account for cost of goods sold, and that's why our gross margins look so good. And so it happens. It happens all the time. We understand because bankers are trying to make these sims look as good as possible, make the financial data look as good as possible. But they as the sellers just need to understand that we're going to dig in hard on those numbers and we're going to unpack them. And when we unpack them, we're going to ask the hard questions and we're going to figure it out.
Well, I love this question. I'm excited for your answer, how can founders surface uncomfortable truths without tanking their own valuation? I want to hear this one. Come on.
It's a great question, and it depends what it is. If it's a legal issue and there's some outstanding litigation, well, maybe there's a way to resolve that litigation and solve that before the deal gets done. So it really depends on what the issue is. But you're right. I mean, it could affect the value of the business. But, if it's going to affect the value of the business with me as a buyer, it's probably going to affect the value of the business with anyone else. And, it's sort of like when you sell a house and you're like, oh, that person's offering me $1 million. And I really think I should get 1.1. And then you're like, I'm not going to sell it to that one for 1 million. And then you end up having to sell the house for 850 grand. That first buyer usually is a pretty credible and good buyer. And if it's a number on the table that you feel is fair and justified, it's worth trying to resolve any of the outstanding issues that are out there with the buyer, or at least to be able to discuss how you think they can be resolved. And if it's a really ugly issue, Adam, we're probably going to walk away from the deal. So it's helpful to understand that early, because then you don't burn 3-4 weeks trying to sell the business only to have us walk away at the end. So if that's the case, you might as well do that up front and do it early so you don't waste all those cycles.
So can you give me an example of transparency early on? Because I went through this with Akamai, right? I knew we were an early stage company. You guys were a tech giant, but we were as transparent as we could be. Just that we understood that you guys understood we were an early stage company and there's going to be issues. There's technology challenges and scale and all of that. But can you give me an example of where a founder kind of got an issue on the table early and actually helped get the deal done?
Yeah, I think, one of the big ones is if you're expecting a customer to churn. If you've been having dialogue with a customer, and they're a top 10 or whatever customer, so they contribute a decent amount to your revenue and your ARR, and they're going to churn, have that conversation up front. Say, this customer could churn, but maybe in a bigger platform, they'll be more excited about staying with this technology. Or maybe we'll figure out a way that we can retain them, but it's probably not going to be at the same revenue or ARR level that it has been historically. But those are the kinds of things that we appreciate when founders bring that to the table and give us that level of transparency, and then we can think about the model, with or without that revenue, and then determine what we think is an appropriate value. But the flip side is you don't tell us about it, and we learn about it before we close the deal. And then the decline in that value could be more dramatic because we're just more frustrated and there's a greater lack of trust at that point. So, or we walk. So, that's a kind of example of something. Or the other one that I mentioned before, if you have some sort of outstanding litigation, or there's someone who's filing a lawsuit, but maybe it's in the early stages, just sort of say, hey, we've got this lawsuit. I think we have a strong case here. We can review it with our legal team. We can determine what kind of risk there is, what kind of cost might be associated with fighting something like that, and bake it into our model as well.
Yeah, it is. It's definitely a dance, right? Because you both want the best outcome for you. So, and there is some gamesmanship, like you're getting a deal done, right? You guys want to buy for yeah. So we have to understand there's some sport in it, but if it's done the right way, you shake hands after. This next point that you, and we did touch on this a little bit earlier, involving the right people. And what comes to mind for me is, as a CEO, you want to involve your people, the right people, but at the right time and for the right duration. Because on the buy side, the more people you can talk to, the more influence you have, and the more pregnant they are with selling
the deal. It's a great point, Adam. And we totally understand that. And we know that in that first meeting, you're probably not going to have every single subject matter expert in that meeting. But as the diligence process progresses, as you progress through the negotiation, and you get better visibility that, hey, we're going to be able to get a deal done here. But these guys need to understand the go-to-market better, and they're asking the same question over and over again, and I just can't answer it well. So I really need to bring my chief revenue officer into the loop. Most likely your executive team is going to be over the wall anyways. And that's really where we focus for the most part. Maybe there's going to be some areas where, the corporate controller or someone like that on the finance side needs to join the CFO to really dig in on some of the numbers, because we can get sort of weedy sometimes. But we understand that, you want to see some seriousness on our side before you just open the kimono as well. And that comes in the form of the information that you share and the people that you give us access to. But, we're trying to be as credible as possible, as well as a buyer. One of the things that's really valuable here at Progress is, my CEO loves M&A stuff. He ran M&A at CA for several years. He loves getting into deals. And so I can bring him onto an early stage company or an early stage call with the CEO. And they're like, oh my gosh, well, their CEO is on this call. They must really be interested in this asset. Build that credibility, build that confidence with the CEO that, hey, we're serious. We've got X $100 million on our balance sheet to deploy here. We're going to work through our diligence process fast. We're going to ask questions that really help us get to a go, no go decision. We're not going to ask all kinds of fluffy questions that aren't relevant to closing a deal. And you're going to see that, and that's going to give you more comfort and conviction to open up more as well. And then, on the negotiation side, as you're seeing progress being made there, as you're seeing that it's not just a one-way street here, that, Progress is going to win every deal term. you get more confidence that, we can get to a deal here. And I need my subject matter experts to get them comfortable with X or Y or Z for us to really get this over the finish line. I'm going to do it. But you're right. Like, we had one deal where, we didn't have access to certain people because it was their last month of their fiscal year on the sales side, because the seller was like, I don't want to distract them. I don't want to distract them at all. And we're like, fine. All right, let's get through a lot of our other diligence. And then just, have your chief revenue officer come in. And, your chief revenue officer has cycles. Let all the individual contributor salespeople who are doing all the work anyways keep selling, and have the chief revenue officer talk to us.
And how often do you see a breakup fee that companies will put in a deal? So we talked about kind of getting pregnant with it, right? I mean, you can really disrupt a business through acquisition. How often do founders ask for that? And what's that?
They don't, and we're never going to agree to one. I mean, you see breakup fees on massive deals. The type of deals that we're doing, whether they're $200 million deals, $500 million deals, you're not going to see a breakup fee. In these early stage CEOs with whatever, 5, 10, 50 million, $20 million businesses, they should not be asking for a breakup fee. They just have to understand, as part of the process, this deal might not happen, but the buyer is not going to give them $2 million if the deal doesn't happen.
That's the Jeremy I know. That's the Jeremy I heard on the other side of Velocitude acquisition. So all this nice stuff. Yeah, here it is. I was asking for it before I even got it out. You knew what I was going to ask, and he's just like, "No, this is not happening." Great stuff.
So maybe we should move on to the next point, because that we don't.
Yeah, we're good. No, we're so talking about the finances and
preparing the financial house, preparing the legal house. Having a good set of financials. We like to refer to it as the financial pack. Having a good view of your P&L, having detail around your operating expenses, having detail about what's in your cost of goods sold, having that ARR waterfall so we can really see, look for trends and understand how the business is really doing, having an anonymized employee census with all the key information that we're going to need to understand, on the legal side, having redacted contracts in place, having all the governance materials in place, having a cap table in place. There's a lot of things, just basic stuff that, just is standard that you want to just make sure you have in place. And that, when I'm, as the buyer, I'm going to sign a LOI, say I'm going to get a deal done in 30 days. But if it takes me 2 weeks to start going through diligence because you don't have any of the material in the data room, or you have to go gather it all for 2 weeks, that's obviously going to affect the timeline. So, being ready, anticipating what they're going to ask for, and this is where, if you don't hire a banker, but maybe you have one of these great advisors, and you were lucky, you had some amazing advisors, be able to say, hey, what should I make sure I have ready for phase 1? What should I be preparing to make sure I have ready for phase 2 in a deal process? And they'll give you good guidance on that. Asking someone in the M&A world or in the investment banking world, hey, can you give me a sample due diligence checklist just so I get a feel for the kinds of things that, a typical buyer is going to ask for, so I can be prepared as I think about selling my company? Those are the kinds of things that, really, the more you can get that in order before a process starts, the better. And then we as the buyer can move.
Yeah, and that's one of the things we do here within the House of Bricks is help founders, because you have to be either, we call it investment ready or exit ready, and it's not an overnight process. Getting your number, the sooner you have them in place, the better off you're going to be. First of all, they'll help you run your business better, it'll help you understand your business better. But when opportunity does knock on the door, you're not scrambling, hey, I don't have a financial model, I don't have an investor presentation, we don't have a go-to-market strategy documented. So founders that are listening, I mean, that's very important to do those as early as possible. And like you said, you don't necessarily have to have a bank.
Yeah.
What's that?
The more ready, the better. And in my role, working with you, I mean, I'm happy to talk to any CEO at any time to give them any sort of guidance on that piece. So they can hear, what's important to me so that they can be as prepared as possible. Happy to do that.
I appreciate that. And what's that?
I said, depending on who's in the audience, how many of them are actual CEOs?
Yeah, exactly. You're gonna get, that's Jeremy Segal, Segal. Find him on LinkedIn, and no, but look, we're looking to wrap up.
Professor at Wharton, Adam.
Okay, I got you. They'll track you down. We've got some hungry people, but I appreciate that. Just kind of moving on to your last point here, and I'd love to hear your answer on this. I've had experience with it, but getting the founder to think about life after the deal.
Yeah, it's a great one, and it's really important. Like, it depends on the seller. Like, there's certain sellers that I've interacted with that have basically built a company from scratch and been with it for 20, 25, 30 years, and they're ready to just cash out and go buy a boat and be done. I have other founders who are so passionate about the technology that they want to make sure they have a key role in the business going forward so they can help really take their vision to the next level. But I think it's also important, as you think about that, is what does this mean for my customers? What does this mean for my employee base? And what's important to my employee base? What's important to my customers? I think one of the things that makes Progress a really strong and unique buyer is we put such a concerted effort into how we're going to take care of customers, how we're going to take care of the people. And we're not going to keep all the people. You know how that works, Adam. But even the people that we keep, even the people that we can't keep, we want to make sure we take good care of. And I think that that's something from a reputational standpoint that's important. But, hearing from the CEO and saying, hey, these three guys or these three women are irreplaceable. You've got to make sure you have them locked in. So, that's valuable for me to understand. So, I can make sure that we have really good retention packages for those people. So it's those kinds of things that, it's important for the CEO to be thinking about and be able to share. Because at some point during that process, I am going to ask, so what would you like to do? Mm-hmm. How would you like to? And if your answer is, I want to just go buy a boat and travel the world, great. I mean, as long as you aren't the guy with all the DNA and there's people below you that can help carry the ship forward, that's fine. But, and if there's a desire to continue, let's figure out what kind of role you can have within a bigger platform.
Yeah, and I'll just say that when I exited Velocity to Akamai, it was very gracious. Just the way we were treated, not gracious, but just good business is how I viewed it. And you guys took care of our team, and so it really is important. And you never know when those relationships are going to come back around. Here we are 15 years later, working together again. So it's the importance for both the buyer and the seller, right? Relationship capital is the most valuable capital in the world. So build those relationships.
One last point on that point, because I appreciate you saying that, because Akamai, when I was at LogMeIn here at Progress, we put an incredible focus on integration planning and making sure that process from going from a small independent company to part of a much bigger company is as seamless and positive as possible. Because that's super important, because you hear about so many deals that fail, and so many deals fail because you spend so much time negotiating the deal, and then you hand it over to somebody and they're like, okay, now I have this, what am I supposed to do with it? We put a lot of effort into making sure that your experience when you join us is going to be a phenomenal experience. And so I think that's super important, and it's fair for the CEO to ask when they're going through the process, how do you think about integration? How are you going to take care of my people? How are you going to take care of my customers? Fair questions for CEOs to ask. And I think it just shows how committed they are to their company as well when they ask those kinds of questions.
That's a great point. Founders, CEOs, ask tough questions, right? You have put your life into this business. You're the leader. It's your job to make sure your team is taken care of. And I think that would actually, from your side as the buyer, like you see some respect and character, and hey, this guy really cares about his team, and right?
Yeah, Yogesh always asks in his first call with the CEO of the other side, what do you want to know about us? What do you want to hear from me? Like, this isn't just a one-way street. Obviously we're trying to learn a lot more. But if you have questions about Progress or about whatever company is that's buying you, ask them. And lean on that CEO or that head of corp dev. And if they don't answer those questions, well, then think about that. Think about why they're not answering those questions.
All right. Well, Jeremy, thank you for joining today. This was awesome. Just to be reconnected with you. Not that we disconnected, Likewise. We just got busy and life, but being a part of the House of Bricks community, being a trusted advisor, and just sharing these words of wisdom. Everyone out there, I'm telling you, there's really good knowledge here from Jeremy. He's done a lot of deals, has the experience. And no deal is ever perfect. You just have to start the process and get to the finish line. Any closing thoughts here as we wrap up? Something you want to leave with our audience?
I think the other piece is, and we touched on it a little bit, but the building those relationships. And remember, this isn't just the company's going to call you up and say, "Hey, we want to buy you." It's more of a let's get to know you. It's sort of like a dating process, and so build those relationships. Build those relationships with companies that could be good acquirers for your business at some point. Let them get a better understanding of your business and what you're doing that's special. Maybe someday they're going to want to buy you. So it's a process. It's so funny. Like people think that, I'm just going to turn around and do a deal. These things take time, and the stronger the relationship you can build with the other side, the better. When I'm doing a deal, I'm focused on building relationships, not only with the CEO and the executives at the company that we're looking to buy, but with their key principal investors too. If they have an investor who's a key decision maker in the process, I'm going to make sure I have a good relationship with them too. I'm not just going to rely on the CEO, because that investor might have a totally different perspective. So making sure those relationships are all being developed, it just helps make the process go more smoothly.
Awesome. Well, thanks again, Jeremy. And thank you everybody for joining another House of Bricks live. We're continuing to go live a couple times a week now, depending on my travel schedule, but we're featuring veterans, top CEOs, guys like Jeremy, corporate development. There's just really a lot of wisdom here that we're sharing, and also giving people a chance to share their story. So I want to thank everybody for joining House of Bricks Live. And whether you're years away from an exit or in the thick of it, remember what I said earlier, preparation is what separates good outcomes from great ones. So thank you everybody for joining us. And remember, we've built this brick by brick.